about you saying that you're only going to be able to deliver it in 7 years' time and on a particular schedule that you've already failed to live up to because we know you don't have the goal to deliver, and, well, we don't want to crash the system.
We're talking with Eric Dubin today. He's the managing editor over at the News Doctors.
This is pretty much a news aggregating site that I personally go out, just like Drudge will do, and pick what I think are the best of the best stories that are out there on any given day, as well as having individual content producers that are producing very unique stuff, and as alternative media developers like yourself, we publish the Daily Coin and your articles as well too.
But I think that you're doing a great job over there, Eric, and I really appreciate everything that you do, all the work that you do, because I know that it takes a lot. It's a huge effort. It's really on my mind right now, Eric, is over the 4th of July weekend, I was with family, and there was an interesting conversation that I had with one of the family members, and it sparked a pretty serious question. And over the past few years, a lot of people have asked or have said that the dollar's going to collapse and that you shouldn't hold dollars. Okay, so if I shouldn't hold dollars, then what should I hold? Should I be exchanging for Russian rubles? Should I be exchanging for the Chinese yuan, the Indian rupee, or the Iraq dinar? And if I'm holding one of these currencies, who is going to accept it here in the United States? I mean, how's that going to benefit me by holding one of these currencies?
Oh, it won't. I mean, well, I should back up. There's a world of difference between the Iraqi dinar and any other currency in the world practically, but certainly with something like the yuan or even the ruble. I remember back in 2004, 5, 6, people would sell Iraqi dinar on eBay, claiming, oh my, it's going to, appreciate 10,000%, get rich quick, blah, blah, blah. And then, the nominal appreciation of the currency did go up, but in terms of its buying power, vis-a-vis what you can actually buy with it practically, because you can't actually take the Iraqi dinar and go down to the local 7-Eleven in any city in the United States and buy anything, So, for all practical purposes, you're essentially asking, what do you hold as a hedge? Either when the dollar is declining at a very rapid rate, or there's some other kind of financial turmoil going on in the marketplace. And
well, I mean, the reason I'm asking is because our audience already is well versed in gold and silver. We all know that those are money, and we all know that we should be holding them. And if you're not, then shame on you. So, but as far as the day-to-day currency, that's what I'm trying to get at.
Right. Yeah. Well, the most fungible and liquid form of true money would be very low, small denomination silver, basically. In the United States, people have a recognition of silver content in the 1964 and earlier coins, minus the nickel, and they would readily make a market in that. I mean, we've seen that over the Y2K period. We've seen it in other times when people were more fearful and they wanted to hedge, they'd go to gold and silver. But for day-to-day type of transactions and whatnot, it is probably not going to be super easy, but it will be possible to make exchanges and benefit from the store of value and status as being outside of the formal financial system that silver coinage can offer. So, if you live in a town that's reasonably small and you can have neighbors that are amenable to bartering and things like that, then that's another way that you can have commerce in times of extreme turmoil. But in terms of store of value, I mean, basically anything that's outside of the financial system and that isn't predicated on paper claims or having risk associated with just the high volatility that can come with a financial asset, where in the market's trading patterns in any given week or month or whatever, if all of a sudden everybody just wants to liquidate and there aren't a lot of people looking to participate on the buy side of any given financial asset, you're going to find it very hard to actually liquidate it without taking a gigantic bath in the price. So those are the kind of considerations that somebody should keep in mind, even if they're holding something like stock or ExxonMobil, or and even if they hold the certificates physically in their hand, in their own personal safe or what have you, and that the percentage claim to the ownership of the assets underground, i.e. oil and gas, that an Exxon would have is, in fact, a hard asset that's a hedge against the quote-unquote financial system if you have the stock in your own name outside of a brokerage account. So there's other things that you can do to get hedged against financial turmoil. It's not just gold and silver. You can also own a significant amount of ammunition stored away. I mean, ammunition is appreciated at the rate of pretty commensurate to what gold and silver have done in the last 5 years. I don't remember the exact numbers, but it's been pretty amazing to see. That 300 some odd percent in the last 5 years, I think, is pretty much an average for any given caliber. In some are, like 22 long rifle are just obscene. I mean, it's up 1,000% or something in the same 5 years.
Yeah, it's actually outperforming just about all the other metals.
Yeah. Lead is precious metal. Diversification is really important. Basically, there's no way to know exactly the timing and sequence of events. And sequence is actually something that's very important, too, because one day you might find that it's really hard to liquidate any kind of precious metal that you hold in your hand, and you're thinking all the while, I did everything right. I got a hedge that is in my hand and no one can take it unless they put a gun to my head, or maybe excess profit taxes can come into play, and if you don't have your paperwork for something you bought, the IRS might say, okay, your basis is the price of zero, and therefore everything that you're selling it for has to be reported as 100% capital gain, and therefore we're going to tax you at it at 50, 60, 70%, or whatever it is that they do as excess profit taxes for all of these social misfits and terrorists that dare to try to hedge and protect themselves from a financial system on teetering edge. I mean, I have every expectation that we are going to see excess profit taxes. And another subject that's relevant to all these discussions, a lot of people are very fearful about confiscation of gold, just like when the banking system was reset in the 1930s. And I don't think that's going to happen this time around. It's far easier with our electronic systems to just say, hey, everything is being tracked, and if you go to a coin store and it's a sale over $500, they got to report it, and we're going to tax you at 70%. Thank you very much. Next.
Exactly.
So,
well, and I don't really, I think that would be very difficult to do at this point, because then I think that's what scares. I think that frightens the authorities or the powers that be more than anything, and I think that's one of the reasons that they're so scared of gold and silver, is because it's a little bit more invisible.
Yeah.
I mean, they can't. I mean, I can go right now, all the transactions that I won in any denomination, no one would ever know it.
Well, that's not 100% true. If you're starting to sell $25,000 worth of gold, you're going to be blipping on lots of radar. And we will be recorded to the point where if you don't report it, your coin dealer may have a problem, and you might have a problem. So that is, I think the transaction threshold is now $10,000 for reporting in terms of, the fiat dollar value of any purchase or sale. And then there are other twists and turns with the law. Like, for example, I know American Eagles are not treated the same way as, say, a Cougar Ram. And I forget all of the various details when it comes to higher dollar value transactions. And that's what I meant by the sequence of events in any given kind of financial turmoil. You might find that it'll be more difficult to do any kind of transaction of significant size on any particular day just because the market's so upset. But, if you're taking a roll of quarters and exchanging at a coin store, that's probably going to be pretty easy, or private barter transactions or individuals purchasing the fiat of the day so you can turn around and buy something with your equivalent of whatever you've got proceeds from the roll of quarters. But, getting back to your original question, diversification is really important. And if somebody has, I don't know, maybe savings of $100,000 or maybe even $50,000 or so, it's probably best to try to get some exposure to that's in maybe farm country, or just has some aspect to it that is a little bit better suited than just generic residential real estate, and particularly not in places like, California or Las Vegas or Miami or New York City or, places that are already inflated again to ridiculous levels. Not so much Las Vegas, but certainly the other places I mentioned.
Yeah, Vegas is not quite inflated yet, but I'm sure they're working on it.
Phoenix,
barter. I wanted to. You've mentioned barter a couple of times in relation to small communities. Most of the people that are probably listening to this live in larger cities.
Yeah.
And I think that from my perspective, I think that barter is going to be a little bit more difficult in a larger city, which is where I live. I mean, I live in a city, and I live almost downtown, and we're trying to change that right now, my wife and I. And there's no way that I would go out if there were some kind of catastrophe that happened in whatever form that it took, that I'm going to get out and try to conduct business if I don't have to.
This would be like you walking around with a sign, "Please rob me."
Exactly.
I got silver. Listen to me jingle down the street as I walk.
Yeah, I mean, it's just the fact that you would be out. I mean, I would think that would be pretty scary.
Yeah.
If there's no electricity, or if the dollar does collapse under those scenarios, I think that it would be pretty treacherous too.
It's a lot harder if you live in a city.
What's that?
It's definitely a lot harder if you live in a city, and we're talking about scenarios that are rather dire of, financial crashes to the point where semi-trucks may not be working to deliver food to the local grocery store, rides in the streets, stuff like that. I mean, things like that happen on a regular basis in the third world, and the prospects for it to happen in the United States, unfortunately, are significant odds, I would say, maybe 20-some-odd% or higher, that we could see the scenario of weeks where the markets just don't work. We had that beginning to happen in 2008, in fact, when the morning of the most dire crash, the credit market completely freezed up, the overnight lending market froze up, and there were inability to get even just generic financing to make goods roll on railroads and trucks and whatnot, and there was a threat that grocery stores throughout the United States were not going to be getting food if the financial system had crashed. And we literally came within hours of that kind of scenario happening. So these situations are not just the rantings of people who are completely paranoid. We came darn close to actually seeing that in 2008. And the way things are now, we could easily see something like that unfold yet again. It's definitely a risk factor that people have to keep in mind. And when you live in a city, it's harder to do the type of prepping that one would need to protect financial assets that you want to have liquid and be able to use on a short-term basis, as opposed to a trusted community in the countryside that can trade with their junk silver. That's just the way things are. But I remember reading a lot of stories about people who in Argentina's various crises, they have one usually once about every decade. And the last time around, or two times back, a lot of people were able to just get their basic needs met by using small links cut off from gold chains. And if you wear 2 or 3 gold chains, you'd be able to maybe buy what you need during the course of any given month when there's a crisis. So it's really just an issue of creativity and diversification in terms of what you hold. A lot of people wouldn't think about a gold chain, but you can throw that on your neck and walk through airports, and no one's going to give you any hassles or anything in terms of declaration of how much money that you're carrying. And the legal limit is $10,000 when you fly, but if we're having a worldwide crisis in the financial markets, who knows what the TSA might be thinking about?
I'd rather not even think about that. they're as out of control as they currently are.
Yeah.
But you had mentioned also sequences and the sequence of events. I mean, and one of the things that I keep going back to once again is Catherine Austin Fitts talks about the slow burn.
Right.
And she doesn't see any type of collapse, and I tend to agree with her, or that sort of thinking, that line of thinking. I don't see the globalists coming in and just annihilating the system and crashing it when they're getting filthy rich off of it. They're, the transfer of wealth that they are able to accomplish at this stage. Why would they change that? Why would they disrupt it when they can just create these little mini crises? And my question is, Eric, do you see Russia, China, the BRICS nations in general, do you see them disrupting that scenario and creating a crash, or do you think that the slow burn is just going to continue?
Well, I agree with Catherine Austin Fitts' thesis about the slow burn, and it's probably been about a decade since I first heard her describe it. And it's essentially pretty simplistic and basic in its analysis, and that's what makes it attractive as a way of framing this discussion. The Chinese and the Russians have already gone through years of playing participants in this slow burn process. The geopolitical and economic power of Russia and China have expanded vis-a-vis the West, and it's been in their best interest to just kind of play along the sidelines, benefiting from the slow transition of economic power moving eastward and the accumulation of gold that they've been able to achieve simultaneously and somewhat in the background and below the watchful eye of most people in the financial world, such that the slow burn works to their advantage. So that I don't see their having any particular interest in upsetting the apple cart in a punctuated way. Just the evolutionary devolution of power from the United States and the European Union is working just fine when it's moving in the pace that it is. It gives them the ability to feather their nest, so to speak. So
because they can just as things fall off, so to speak, here in the West, they just pick them up and keep running with them.
Right.
They're just acquiring them.
And then as far as how people in the West benefit as things are set up to concentrate wealth, with the Fed having super low interest rates and goosing capital markets, we see the 0.01%. The social justice movements on the left like to speak about the 1%, but frankly, there's, you have $2 million or $1.5 million, you're in the 1%. I mean, it's not, all Warren Buffetts that are confronting that statistic. But in any event, the super wealthy have continued to get even more wealthy by, the economy being hollowed out with all this malinvestment and whatnot, with central banks all around the world goosing the credit-based fiat systems of all of our respective countries. So I don't think it's in really the powers that be's interest to see things crash either, even though a lot of people would speculate that this is all planned and that they're trying to, crash the system. I mean, even Catherine Austin Fitts has spoken about, I believe it was in 1995, she had a conversation with the head of CalPERS, which is the largest employee pension fund, and it's based in California. And California being 10% or so of the population, you'd expect all the teachers, unions, and fire departments, and all the various government-related jobs that feed into CalPERS would result in a giant fund, and that's in fact what CalPERS is. It's a huge pension fund. And they told her, or the CEO, or equivalent, I forget what the title is for the guy, he said basically that, when there was a decision made that we're going to hollow out the economy, send jobs over to China, let China industrialize, and that's all because, we can benefit by making profits from pushing paper around and making monies off of intellectual property. Well, we don't need this dirty manufacturing manufacturing stuff. We can manufacture dollars and buy everything from, countries that are gullible enough to sell it first, our most desired imports for stuff that we create out of thin air. And that whole hyper-financialization has been going on all this time. And, some people point out and say, hey, that's an indication of the powers that be planning to just let the system inflate to the point of imploding. And thereafter, the profits that people were able to make on the way up, combined with knowing what's going on, being able to profit on the way down, result in capitalizing all of this financial turmoil. And to some extent, that does happen. But ultimately, I don't buy the thesis that it's a grand scheme and that the highest levels of the powers that be weren't planning on crashing the economy per se. It's just an outcome of where the economy moves, given all of these excesses.
It seems like a natural occurrence.
And all of the various personal self-interests of all of the actors involved make it such that this whole fiat system works well to their advantage, makes the wealthy all the more wealthy, concentrates wealth at the top. And just the nature of the system is such that, if we continue to prevent the normal cleansing of the economic cycle, of the business cycle, particularly as seen by Austrian School of Economics, you end up with gigantic malinvestments, and there's no better description of where we are right now in our financial system. With 1.5 or whatever trillion derivative positions and counterparty risk that is easily vulnerable in 20-some-odd% of the entire banking system of the Western world. At some point, that bubble is going to hit something that will make it burst, and it's most likely going to be the credit market.
Do you think that something is going on in the background in the derivatives market right now that's festering and that hasn't surfaced, but that I personally kind of get the feeling that something's broken in the background.
Yeah.
And that they're patching it together as quickly on a daily basis as they can. What do you think? I mean, do you think that something like that has happened or is happening right now?
Yeah, it's happening right now. When you look at what's going on with the Treasury bond market in the United States and Belgium sitting in for the purchases that exceed what has been removed by QE. I mean, this whole QE thing is kind of an illusion. They are claiming that we're tapering, and the amount that Belgium has stepped up and purchased in terms of 5-10-year bonds from the United States Treasury exceeds what the Fed has reduced in terms of its purchases of assets of Treasury. So right there is proof that there has been a concerted effort to basically replace the buying that the Fed was doing, because there's a problem of not enough buyers for the sovereign debt of the United States. And if there were, in any given bond auction, insufficient purchases, they basically have to back that up. Otherwise, interest rates would rise, because the normal bond market action would demand that if the credit risk was indeed something that would threaten the prospects of being paid back if you bought a bond, well, you're supposed to be compensated for that risk by having to be rewarded with a higher interest rate payment to give you more reward for taking on greater risk. And that's
we're not going to have any more interest rate rises. I don't think that's ever going to happen.
I mean, look at today. We're recording July 9th, and it's the most bizarre market actions going on today. We have the 10-year diving once again, and we're getting pretty close to 2.5%. And at the same time, the stock market's going bonkers to the upside. Gold is catching a bid. just all these counterintuitive type moves are going on, because practically every market is manipulated at least once a week, if not on every given day. And all of these excesses have been building up in the system as far as malinvestments and whatnot.
How do you think they're able to pull all the levers that are being pulled as far as the manipulation, and you just mentioned 3 or 4 different markets, and we know they're all rigged. I mean, that just seems like an enormous management job. I mean, these guys have management skills that are off the chart. I mean, from my perspective, I mean, because like you said, you've got the bond market going crazy. You've got the gold market catching a bid. The stock market is on its way up. I mean, so somebody's got to be overseeing that and pushing the buttons and pulling the levers to make it do what they need it to do in order to not just blow up.
Yeah, and that's not, some kind of conspiracy theory. They are very open about the bond purchases that they make for the QE program, and the Treasury is open about, somewhat open, I should probably say, about how the various committees like the Plunge Protection Team, as it's commonly known, with the Presidential Working Group on Markets established after 1987. I mean, these things are public record. It's not like these are the rantings of conspiracy theorists. There are, Bank of International Settlements that get involved in currency stabilization efforts that end up spilling over into managing and manipulating the bond market as well. And so all these things are going on in the background. And then when you get the kind of complacency by money managers who either just see a trend and say, okay, it's going to continue until it stops, and in the meantime I'm just going to benefit by going along with the trade, you get that copycat activity that supports whatever the central planners would like to see in the marketplace manifest. So, that's where we are in the bond market as but one perfect example. A lot of monies from all around the world, more so than in, say, U.S. pension funds or whatever, looking to just park money in a short term will go into the bond market, and knowing that the Fed has their back and that interest rates will not spike much higher because the Fed, in previous instances, whenever we would go to a 3% rate with the 10-year, out comes Bernanke or Yellen and the Treasury Department and whatnot, and they're moving the bond market down with outright purchases, even though they, claim that they're tapering. But as I illustrated with the example of Belgium, they literally are purchasing bonds to support the market and not telling people about it.
Well, yeah, and the average citizen in the United States isn't going to question it. They're not even going to know about it because it's not recorded on the Kardashians. Eric Sprott has mentioned the 2,400 by the end of the year, and then the interview that he did with the doc a couple of weeks ago, he actually gave a great explanation of why he sees that, which is why I asked you about something breaking in the background of the derivatives, because that's what, if I remember correctly, that's what he was saying, is that the derivatives market is going to break, and that's what's going to create the bid in gold. And are you on board with that idea, or do you think that there's going to be something else that drives gold for the rest of the year?
It's actually kind of relevant to the slow burn thesis as well too. And when you say break and speak of the derivatives market, you automatically come to visions of just everything cascading in the credit default, and that the counterparty risks in the derivatives market won't be, there's not enough strong hands to back up all the various insurance claims that are represented in, for example, the credit default swaps and insurance swaps for the interest rate market. There's probably some $500 billion in just interest rate swaps alone. And you don't need to have a full break in the market to get to $2,000+ gold. If it looks like the market is teetering and that there's stress, that there's a possibility of a break, then that could in fact get to the numbers that Eric Sprott is talking about of $2,400 gold, etc. I don't think we're going to have a derivative bust this year, and to some extent, I'm more leaning towards the idea that it's more likely we would have partial derivative market fissures showing up, and that the powers that be will dump a lot of money on the problems and try to paper them over, and that would push gold and silver into that $2,000 to maybe $50, $60 silver range for the metals. But the interesting story is what happens next. Because we can get to those prices without having, riots in the streets and total pandemonium, because the fundamentals are such that the debasement of the purchasing power of fiat currencies of major countries has already justified a gold price of $2,000 plus and silver $50 or more. It's just not showing up because we have Pavlovian obedient market participants that have been beaten over the head with all the manipulation in these precious metals, to the point where the numbers that we see now are so artificial. It wouldn't take much, basically, for the beach ball to pop up to some kind of reversion to the mean or realistic prices that would represent something of closer to fair value. But in actuality, if we have a derivatives market crash, $50,000 gold and all these other crazy numbers that people have thrown out really are not that crazy. It's just a question of how bad things get. And the probability of some scenario like that unfolding is actually materially high enough to the point where it should scare the Jesus out of most people. But most people are completely unaware of this risk, other than, say, preppers and the 0.7 some odd % of the American population that's participating in precious metals and various communities like that.
Yeah, and it's a very, very small number that is aware of what's actually going on. And what do you think that it's going to take to get more people, bring more people into the fold?
Inflation will probably be the trigger that gets a lot of people to start waking up and looking at things, and I think we're going to start seeing inflation later this year that is so big that the powers that be will not be able to hide it.
Well, I would think that we're already there. I mean, I personally experienced inflation to the tune of about 8% to about 33%. I can think of 2 or 3 items just right off the top of my head that fall right comfortably into that category.
Yeah, certain foodstuffs easily 30, 40% in the last 12-month period. And particularly as things have been sticky in their prices a couple years back, and then all of a sudden manufacturers say, okay, we've got to catch up, and all of a sudden you see big shifts in prices, or the size of products and packaging changing to try to hide the amount of lesser product that you're getting for your dollar and so forth. We're at a stage now where the management of gold and silver downward is no longer capable of being done the way it was done in 2013, because that whole dog and pony show was executed by raiding stockpiles. The GLD's vault was lessened by something like 500 metric tons, if I remember correctly. But the point being that the vast majority of the price decline that we saw in silver and gold was facilitated by raiding of these vaults and sending this gold eastward to satiate the demand coming out of principally China, but throughout the rest of Asia, Singapore, Indonesia, Vietnam, Thailand, and then Russia and the Middle East have all been, and Turkey, and been very large buyers of bullion, to the point of, at the very least, 2 times and probably 3 or 4 times the actual supply that's coming out of the ground. And the only alternative places to have gotten the gold that was used to push the prices down were these vaults and the central bank holdings, too, as they leased more. And that supply has been diminished to the point where if it were the objectives of the poverty to push prices much, much, much lower, they just simply can't do it because the gold and silver are not there to facilitate it. I mean, people make a big deal about the huge leverage on the LBMA and the COMEX and the paper that's able to be the tail that wags the dog, or the physical trade of gold and silver, versus all this paper mountain monstrosity that we have in these bogus financial markets. They're more like casinos than anything else. Not markets that are set up to have price discovery, but price bastardization, basically.
Right.
So
where's the gold going to come from going forward?
In the sense of not being able to manipulate, that it's not going to come.
This where we already know that China alone is taking at least all of the mining supply globally.
Right. Yeah.
The equivalent thereof, I should say.
Yeah,
so where
like
is India going to get gold? Where are people going? Where's the gold coming from? Because I mean, you're part of the News Doctors is part of the Silver Doctors Network, which is connected with SD Bullion, and you guys have right now 2014 Gold Eagles. Where is that gold coming from? And I ask this question of everybody.
Well, we have the ongoing mine supply, and then you have vaults that have been radiated, and that there is more gold on the marketplace now that is accessible. But in terms of the gross dollar value of gold and silver that are being purchased out of the United States mint inventory, it's relatively small in the grand scheme of things compared to most financial assets and the percentage of people that are participating in the market. So there's a tightness to the market, and you can see the proof of that by the fact that on June 1st, everyone and their dog, practically, even people in the precious metal space, were freaking out, thinking that, oh my God, silver just cracked 19 and it's threatening to go below 18, and gold sliced through 1250 support and hit 1245, and everyone on those 48-hour period or so was thinking, well, this is it. Powers that be have been able to once again bamboozle everybody and push the prices down because they're all-powerful and they have the ability to manipulate the markets. At that very moment, I called the bottom and said, look, this is not going to turn further down, even though the technical charts and technical analysis is motivating people to think that this is just a dire scenario where silver is going to 15 or lower. And gold, 1,200, 1,000, who knows? If you believe in, the puffery that comes out of Goldman Sachs, even lower prices. But the fact that we turned around is just one example of the dynamic that we spent, a number of minutes talking about all of these inventories that were rated in 2013 to make the manipulation lower possible are no longer available. Even though the retail customer can go to a coin store and buy, 10 Cougarans or American Eagles or whatever, I challenge that same person to go and try to deploy $5 million worth of capital, and they're going to have a problem. So the market is accommodative enough to the fluctuations in supply and demand for the physical market buyer that's relatively small, but if somebody even today wants to buy in size, it's going to, run up into some difficulty in terms of sourcing. If you're talking $5 to $10 million purchases.
A buyer of size, say, like Germany?
Yeah, well, yeah, there you go. That's same dynamic on a far grander scale, but it's the same thing.
Well, I was referring to them trying to get their poultry 300 tons back from the Federal Reserve, and now they've been told twice they can't even look at it.
Yeah, no auditing, and then they were shipped 5,000 metric tons in 2013, and then in the beginning of the year, or near the first quarter's end or so, they were promised that they would get, I think it was 45 metric tons.
Correct.
And I misspoke a second ago. I didn't mean to say 5,000 metric tons, but they got 5 metric tons, if I remember correctly.
Exactly.
Yeah, so, and they have, if I remember correctly, something on the order of about 1,200 metric tons in allocated storage throughout other central bank depositories, including the United States, and the majority of that number was in the United States, so 800 or so metric tons. And the latest is that they're saying in their media, maybe we won't worry about you saying that you're only going to be able to deliver it in 7 years' time and on a particular schedule that you've already failed to live up to, because we know you don't have the gold to deliver, and we don't want to crash the system.
Right.
So you guys can just hold the gold for now, and we'll talk about this stuff later. Let's just not talk about it. I mean, basically that's the subtext of what the Germans have been saying in the last months. So it's all kind of comical. I mean, everybody's looking around knowing that they're playing a grand game of musical chairs and well aware that there are far fewer chairs than anyone wants to talk about.
I think that's probably a good spot to stop.
Yep.